And now we are 129, which is a very good number for options. Which is a very good number for options. Very good number for options. In light of getting their 1,000 students extra, let me also go live on Facebook. This is the first session of block release. So it's called option model of hedging. All right. So, ladies and gentlemen, then what have we been able to do so far? We are looking at the protection mechanisms which you need to put in place to ensure that your money is guarded. Remember, as an investor, when you send your money outside there to go and look for money for you, remember, as I did some video on YouTube, I hope you got that video. I told you that your very best employee is your money. Your money. So you invest, and this money goes there, brings something on top in the name of interest, dividends, etc. Then there is also a possibility that this money could be exposed to danger, could be exposed, in this case here, to risk. There is a chance that you may lose 100%. So in this case here, for you not to lose, you need to put some mechanisms that will be able to prevent you from getting into lost area. Nobody wants to lose, ladies and gentlemen. Remember, as much as possible as we say that they higher the risk, they higher the returns, it reaches a point like now where we are, most of us, almost 50 years. Would I want, in this case here, to place a 10 million bet and then it disappears? I'll be jeopardizing my retirement. My retirement would mean that I'll be a poor man, that I'll be picking my call like this to call my kids that send me 10,000. I don't want to do that. I would want to be at a position where I will continuously help them as a parent. Of course, it doesn't have to be like stipends, giving them stipends when they are old, but you see, as a parent, still, parenting doesn't end. All right. I would want to be at a position where I should be of help to my children, including great-grandchildren like that. So I don't want, in this case, to invest dangerously. No. I would have to sit back and ask myself, fine, I've sent this money to go to Saudi Arabia. It has crossed borders here. Then how do I ensure that these goods that I've sent outside there, I'll be able to get payments here? For example, I must ask for letters of credit from, in this case here, banks that will be able to guarantee, for example, people that I'm selling goods to outside there. Otherwise, if somebody is outside Kenya, honestly, where will you start tracking this guy from if, for example, he was to just disappear with your supplies? Nowhere. So you need to put safeguards. Those safeguards are the ones that we are calling what here? Hedging techniques. But in this light, we are looking at hedging techniques in terms of Forex, foreign exchange. And I've given you various methods. Number one is the do nothing if the money is involved are immaterial. And I gave you a very good example. There is no way somebody, for example, will answer my question very well here, and then I give them like $100, and then these guys, in this case here, for example, they go ahead here to wear high-heeled shoes, bouncing in town, looking for bureaus to hedge. $100 is nothing. The very best thing this lady will do is simply to walk to any bureau, and then they'll be able to exchange, because the amount involved, ladies and gentlemen, is quite immaterial. Remember, hedging does not come for free. Hedging is going to cost you some money. There is a cost involved. If it's an option like the ones you're looking today, then, ladies and gentlemen, what will happen here is that you're going to be told to pay some premium upfront. So if the amount involved is very small, then the cost of hedging will outweigh the benefit. So in that case here, you are better off doing nothing. So you do nothing there. Number two, you have to hedge as well using forward contracts, using, in this case here, money markets. And now we are on our fourth one called what here? Options. We're writing there number 4, options. Right there, number 4. Is it number 4 or number 5? Is there any that I've skipped? Is there any that I've skipped? Is there any that I've skipped? Like you guys, are we together? You're transferring risk to clients, in this case, invoicing in a preferable currency. So this one, for your proper move, for your proper, in this case here, flow of your notes, mention it as number 5. Mention it as number 5. And then now, if you're together, please put your thumbs up like this. Put your thumbs up like this. Now, number 5. If you're keen enough, like the question that we were doing yesterday, part C of it had a hedging technique called options, part C of it. But you see, I can't do part C of that options hedging technique without first of all giving you a background. I must give you a background. As colleagues, you know, at this level, I don't call you my students. This level, all of us are scholars. You're at an advanced level. After this, I expect you to teach me. One day I should be able to sit down in your class, you teach me in a very actually advanced way. You know, nasema kwa Kiswahili kwamba kinachozaa ni kizuri zaidi kuliko no, ni opposite. Kinachozaliwa. Mtoto wangu anafaa kuwa mwerevu kunishinda. Anafaa kuwa mwerevu kunishinda. So nyinyi kama watu wangu sasa, inafaa after some time mwe waerevu kushinda mimi by far. Yes, Mudhoni is offering to teach me these options here. So here we are, ladies and gentlemen. Look at this name here. Let's define this. Look at the word options. Options in this case here, ladies and gentlemen, in this case here, options stand for what here? Alternatives. You need alternatives. They are called what here? Alternatives. Just like, for example, we are told here, it's very important in life for us to have what we call alternatives. You should never, in this case, just stick with one option, with one alternative. Have always 1 or 2 or 3. Even in life situations, always have what we call options. So when you talk of an option, ladies and gentlemen, we are supposed to know that an option is a financial instrument. An option is a financial instrument. Is a financial instrument that gives the holder the right, but not an obligation, the right, but not an obligation to buy or sell. A specified quantity of a security, at a predetermined price, at a predetermined price. So it gives the holder the right, but not an obligation. You're not obligated. The only thing that is optional, there is no obligation. Which reminds me of a certain case which was in the media here. Some young man was to marry some lady. And they had really organized, everything was very well set up. All right. Now, during this material day of the wedding, the young man never appeared. So, of course, it was quite a disastrous thing. It was a sorry state of affairs. So this lady, in this case here, took this young man to court. I mean, for not having come up in this great day of hers to marry her. So if you were the judge in that courtroom, what kind of, in this case here, judgment would have you delivered? Would have you, for example, delivered a judgment that you, hey, young man, it's a must, go and marry that girl? What kind of a judgment would have you delivered if you are the judge there? Remember, this is something that had passed through all processes, including in this case here, for example, pastors calling and saying, is there anybody who has got an issue? Round 1, nobody was raising. Is there anybody who has got an issue? Round 2. All right. Right, okay. So it is quite a disastrous moment, but at the end of the day, as somebody is saying there, it seems that this man, for example, could have changed his mind. And of course, there is no obligation, really. There is no obligation, trust you me. That lady cannot win that case whatsoever. Because in this case here, it is a right. All right? In this case here, there is no obligation. There is nobody who can come with a gun and tell me that, hey, you must marry Naomi. No, 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 no. So in this case here, financial instrument, this option is a financial instrument that gives the holder the right, but I'm not obligated. There is no obligation. There is nothing like mandatory. Nothing like mandatory. There's nothing like mandatory. There is nothing like what here, a contract. There is no contract there. There is no contract there. So whenever it's an option, from the word optional, you are being given the right, you have that benefit, yes, but there is no obligation on your side to execute any kind of what here option. It's not a contract. It's not a contract. Tell us that there are two types of options. There are two types of options. There are two types. You can opt in or out. Thank you, Shelly. You can opt in or out. You can opt in or out. I mean, it's an option. It's an option. There are two types of options. There are two types of options. Number one, we have what we call a call option. We have what we call a call option. So from this word, call like this. So the call option basically is a financial instrument that gives you the right, but not an obligation to buy. So call means buy. So a call option gives the holder, it gives the holder the right, but not. The right, but not. It gives the holder the right, but not an obligation. The right, but not an obligation. The right, but not an obligation to buy a specified quantity of a security, at a predetermined price, at a predetermined what year? Price, at a predetermined price. It gives the holder the right, but not an obligation to buy a specified quantity of a security at a predetermined what year? Price. So whenever you hear the word call, you know, call, you are calling for this merchandise to buy. So it gives the holder the right, but not an obligation, to buy a specified quantity of a security at a predetermined price. Have you guys been able to write this first type of an option? Please put your thumbs up like this. Thumbs up like this. All right. Then we go to the second one. The second one is what we call a put option. The second one is what we call a put option. So a put option gives the holder the right, but not an obligation to do what here? Somebody to sell. Please, you should be able to know how to write very fast like myself. You should be able to know how to write very fast like myself. You should have finished writing this thing as yesterday, as early as yesterday. I've changed just something small here. So you're putting this thing up for sale. Putting this thing up for sale. You're putting this thing up for sale. So once you finish, I don't know what Janet means with a D. Done. Oh, D for done. Oh, okay. Put option. All right. Now, ladies and gentlemen, please listen and listen to me very well. We have got two types of options, and the examiner will always ask you to differentiate between a put and a call option. And I'm so sure anybody who has been in my class will be able to remember this very well. And these things are very, very practical. So, for example, ladies and gentlemen, assuming you are a hotelier, you're running a hotel in this Nairobi. Let's talk of a restaurant really, because the hotel, you not have so much use for chips. All right. So you're doing a restaurant in this Nairobi, and really you would wish to get lots of bags and bags of potatoes, say on a weekly basis. Now, ladies and gentlemen, when you look at, for example, the price of a packet of chips in town, a packet of chips in town here goes for approximately how much? A packet of chips in town. A packet of chips in town goes for how much? Approximately. Yeah. 150, right? Around 150, yes, around there. Now, does that price fluctuate often? So as a restaurant owner, can you wake up and say, for example, that, hey, I've been charging 150 today, I'll charge 200. Does it fluctuate that often? No. Once you adopt your price, like there are some restaurants you normally see there in town. When you were young, we used to get those packets of chips at about 80. Almost 20 years down the line, they are still around that range. You can't just wake up and increase the price of that commodity like that. It's one of those commodities, just like salt, which seems to stagnate. But now let me ask you a question. We know that chips ni waru. We normally use potatoes to make these chips. Ladies in the house and gentlemen who would be knowing, what do you know about the price of potatoes in these market areas? Potatoes, raw potatoes, do they remain like constant or do they fluctuate a lot? They fluctuate a lot, isn't it? Potatoes prices, they fluctuate a lot. Like right now, I don't know, during these rainy seasons, the ladies again in their house, I'm so sure there could also be some men who know this. How much approximately does a 90 kg a sack of potatoes cost? Somebody could be knowing at the moment, given the rainy season, how much does a sack of 90 kg? 900, what do you mean? Kasuku ni 120, 𝐷𝐵 goes for about 900. You can see a full sack is about 4,000 to 4,500. Are there times in this case here the potato prices, for example, per sack goes as high as 7,000? Are there times it goes up as high as 7,000 Kenya shillings? Oh, okay, 6, yes, okay. All right. So then, ladies and gentlemen, if I'm a restaurant owner in this Nairobi, what I would do, I would go to, for example, where they are known for planting, in this case here, these potatoes. In Kenya here, of course, it must be somewhere around Murang'a. So I'll be able to get a very nice farmer who has got, for example, like 30 acres of land. And then I'll be able to empower this farmer. Instead of his land being idle, I tell him, you know what? I'm going to give you, like, say, 200,000. And I want you to do me a favor. This land of yours, in this case here, just plant potatoes for me. And then we enter into an option with him. So we have, in this case here, an option, kind of a contract written down. So this is how the option will look like. So I'll tell this farmer, I've paid you something up front. I've given you what we call a premium of 200,000. I've paid this upfront. You'll be able to buy seeds, whatever you plant. And of course, he's also going to amp in his money because, this is his own venture, all right? That will be extra money. So then I'll tell this guy, in 6 months' time, I'll come to buy these potatoes from you at a price of 3,000 per sack. A price of 3,000 per sack. A price of 3,000 per sack. So in this case, I will draw an option. If it's an option, we have drawn. So now we have an option that Dr. Joshua Aura will come, in this case here, on this specific date to buy a sack of potatoes, like 100. It has to be very specific. 200 sacks of potatoes, each at 3,000. Now, if I had a contract with this guy that is optional, if I have an option with him, this is what is going to happen. When it reaches this time of harvest, I'll walk around this area, Murang'a. I know Murang'a, Kenokobil. I'll walk around there. Here, in this case, here in the market, the average price of potatoes. So as I'm walking around, if I get somebody who is selling these potatoes for 1,500, for 1,500, remember, it's an option that I had with this Murang'a person. It's an option that I had with this Murang'a person. So if I can get cheaper potatoes, what I'll do, I'll not even go telling him bye-bye. I'll just leave him to do whatever that he would wish to do with the potatoes, because I had a right. I would have gone to him to purchase without him, in this case, saying no. But now that I've gotten a cheaper option, I'll remember this second clause that I do not have what here any obligation. There is nothing like mandatory here. There is nothing like mandatory. And the right which I have, I bought it by paying the premium. That's why you pay the premium. So even yourself, you shall now lose the premium. But now I need to compare. Look at, in this case here, I mean, in all balance of probabilities, if I'm able to save like even just 1,000 per bag, then I'll be able to go for an alternative. So an option gives the holder the right, but not what here, an obligation. Like in this case here, to be able to buy these potatoes at a specified price. And should I find that price to be very high, then I know that this is but one option. I've got other alternatives. I've got other alternatives. I've got other alternatives. I've got other alternatives. Now, ladies and gentlemen, please listen and listen to me very well. Please listen and listen to me very well. We shall go straight away to what we call option valuation. How do we value options? 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 How do we get to value options? And I would want us to study today the concept of valuing call options. Call options, call options, call options. All right. We have got two methods which your examiner prescribes that you should be able to really be thorough with in terms of option valuation. We have number one, the binomial tree of model. We have number one, what we call the binomial tree model. And then number two, we have here the black skulls model. Somebody told me some time back that we should be using the word short. I don't know. I find skulls to be much better. Skulls to be much better. So we have to be thorough. For the number of years I've marked these exams, ladies and gentlemen, I know so many of us become only go with this. We forget about this, and this is really the most popular one nowadays. This one, binomial. Anytime in this case we bring a question on binomial, I can count the number of scripts of students who will be able to draw this binomial tree and of course give us correct values. I can count. The scripts which I cannot count are the ones who are going to get it wrong, or the ones who will even leave the whole of this question blank. The question in context here, which I would want us to use as our benchmark, is this question that was tested in April 2023, question number 2B. April 2023, question number 2B. I'll not do it directly because I have to give you some background, but I would really request that all of us get this question out for just reading purposes. For just reading purposes. For just reading purposes. Page number, for the ones who are using this book, we are looking at page number 145. We are looking at page number 145. 145. 145, Janet Rotuku. Page number 145. Are we there? April 2023, question number 2B. April 2023, question number 2B. April 2023, question number 2B. Once you get it as a good ninja, you need to hit the thumbs up very fast. I already said that we are there, Mwalimu. We are there, Mwalimu. Thank you very much. So if you read this question, consider a 2-period. This examiner was quite tough on my students. This examiner must have thought that I'm the one who was sitting for this. How would he test this 2-period? 2-period. As I lay down the ground, of course, I'll first of all teach you guys single-period model, and then I'll go for the 2-period model. Consider a 2-period binomial model in which a share currently trades at a price of shilling 65. The share price can go up 20% or down 17% each period. The risk-free rate is 5%. So they want us to give them the price of a put option or the value of a put option expiring in 2 periods with an exercise price of what year? 60. 𝗕𝗃𝐺 is asking which page. Are you able to tell 𝗕𝗃𝐺? Are you able to tell 𝗕𝗃𝐺 now very fast? He's just joined, out to believe. And nowadays I don't get to see 𝗕𝗃𝐺 so much. I don't know where he went to. 𝗕𝗃𝐺 karibu sana. So 𝗕𝗃𝐺 now, you've gotten this page number 145. The question is April 2023, question number 2. I'm so sure he's not the only one who hasn't gotten it. I'm so sure he's not the only one who hasn't gotten it yet. All right. All right. So then, gentlemen, please listen and listen to me very well. These guys want me to use the binomial model. They want me to use the binomial model. So how do I get using this binomial model? I can't do that question as of yet. So I've got simple examples that I have with me here, which I would want to use like a kicker. A kicker. Yeah, Maurice, in this case here wants, oh, this is the Maurice that everybody is talking about. This must be a senior citizen. Senior citizen. I hope he's a good ninja. I hope he's a good ninja. So, so, so I would want us first of all to do some simple examples. Or do you want me to start with the 2 period directly? Is there somebody who has got that energy of Mwalimu? We can withstand this. We can withstand this. We can withstand this. Nobody. Teaching pedagogy says you build up a case. You don't just shoot up there. We build up the case step by step, yes. So mention there, example, stepwise, yes. Example, the current price of a stock option is Kenya shillings 80. The current price of a stock option is Kenya shillings 80. Is Kenya shillings 80. The size of an up move, 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 the size of up move is 1.4. The size of up move is 1.4, and the risk-free rate, and the risk-free rate, and the risk-free rate, and the risk-free rate is 6%. The risk-free rate is 6%, full stop. The strike price, the strike price, the strike price, the strike price of a call option, the strike price of a call option, the strike price of a call option is Kenya shillings 80. Is Kenya shillings 80, and expiry is 1 year. 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 Using a binomial tree, using a binomial tree, using a binomial tree, determine the current value of an option. 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 So this is not a revision kit. You can see how black the book is. You have to copy the question, and then a good ninja should be able to take like a screenshot, and then they share on the group. They share on the WhatsApp group. A good ninja should be able to do that. A good ninja. Let me repeat the first sentence. So we are told here, the current price of a stock option is Kenya shillings 80. The current price of a stock option is Kenya shillings 80. Kenya shillings 80. The size of an up move. The size of up move is 1.4. The size of up move is 1.4. And the risk-free rate is 6%. Full stop. The strike price of a call option is Kenya shillings 80, and expiry is 1 year. Expiry is 1 year. Using a binomial tree, determine the current value of an option. The current value of an option. So do we have now the whole question clear? Do we have the whole question clear? Do we have the whole question clear? Okay. There is a ninja there who hasn't yet gotten the question very well, who can't see even the board. Are you able to take like a screenshot and then you screenshot of your notes, of course, and then of course you send him in the group there. You send him in the group there. We have already sent. Thank you very much, Mudoni. Mudoni must be coming from Muranga. Mudoni, do you come from Muranga? Oh, your mom. Oh, great. Great. Mudoni already shared. Thank you so much. Now, ladies and gentlemen, when we hear of this word binomial, what comes to your mind whenever they talk of the word binomial? What comes to your mind? 2. Thank you very much. Remember when you went to Form 1? Those guys must have, in this case, they labeled you a mono. In Form 2, they called you by something. By means 2. By means 2. So basically, by meaning 2, it means that this stock, which is currently going for 80, the spot price at time 0 is 80, it could either go up or wet here down. So that's why they spoke of an upward move. An up move is 1.4. 1.4. So always we shall be having up and we shall be having what here down. Two possibilities. Two possibilities. Now, ladies and gentlemen, binomial nomenclature, you must be a good ninja, Brian. Now, ladies and gentlemen, if they have given us U, they have told us U is 1.4. The first thing that I need to do is to get the down. The first thing that I need to do is to get the down. So how do I get the down? What I need to know is that there is an inverse relationship between up and down, an inverse. In short, to get down, we shall take 1 over U. 1 over U, which will be 1 over 1.4. So in some cases, in this particular case of our past paper, he gave us upswing and he gave us downswing. That was pretty cool. That was pretty cool. But in most cases, they only give you one of them. It is you now to figure out how to get the other one. But fortunately, we know the reciprocal relationship. We know the reciprocal relationship. We know that anytime they give us up, to get down, we shall be taking 1 over the up, which is 1 over 1.4, which will end up giving me what figure, ladies and gentlemen? Which will end up giving me what figure, ladies and gentlemen? 0.71. 0.71. 0.71. Remember, Rebecca, there is even nothing really here, Rebecca. Just knowing, for example, like if you're told here, U is 10, then how do I get down? It will be 1 over 10, just like that. 1 over 10. If I'm given U is 1.4, then to get down, I'll take 1 over U, just like that. Just like that. That is the relationship that all of us should be able to appreciate. That one is a reciprocal of the other. When I use that word reciprocal, I'm so sure I lose out some of you. I lose out some of you. So all of us now, are we able to understand that 0.71 thing? 0.71 thing. Thank you so much. Now, from there, ladies and gentlemen, I will go to the next step. The next step is the step of probabilities. The next step is the step of probabilities. The next step is the step of probabilities. So the step of probabilities. Probabilities. And the probabilities here, we normally use pi for probability. And the first thing you need to do is to come and give us the upward probability. How do we get upward probability? To get upward probability, we normally take 1 minus risk-free rate, plus risk-free rate, minus the down parameter, all over the up minus the down. Anytime you want to get up, I hope you wrote somewhere here that this U stands for upward, or up. So probability up is 1 plus risk-free rate minus down, all over U minus down. Can I give you 1 minute to try to substitute and then you tell me whether you'll be able to get this answer? Let me give you 1 minute. Yes, it shall be recorded. Yes, it is being recorded and it shall be uploaded. Yes, I confirm 100%, but I would really wish you guys, you can hang around until we finish this class. Until we finish this class. So please substitute there. And then we see whether there is any student who will be able to give us, we get to see whether there is any student who will be able to give us, this probability. All right. So have they given me the risk-free rate of return? Oh, yes. The risk-free rate of return here is 0.1 here, somebody. The risk-free rate of return is 0.1 here, somebody. It's given there. 0.06. Thank you so much. So 0.06 minus the down that you guys have just computed, which is 0.71. All over the up that the examiner has given us, which is 1.4, minus, in this case here, down, which is 0.71. So from there, you get your calculator. So first of all, you give us, you give us the up. Give us the up. Probability of up. So first of all, I'll get here the numerator, which is 1 plus 0.06 minus 0.71, which gives me, ladies and gentlemen, 0.35. So here, the numerator is 0.35 all over the denominator, which will be 1.4 minus 0.71, which gives me, in this case, ladies and gentlemen, 0.69. And I get the quotient, which will be 0.35. 0.35 divided by answer, which gives me, ladies and gentlemen, 0.5072. 0.50. Is there somebody who got this kind of an answer? Is there somebody who got this kind of an answer? Or 0.51? Pretty same. All right. Thank you so much. So we have gotten probability of up. Is there somebody who can tell, given that we have only two possibilities, is there somebody who can make a comment about probability of down? Anybody who can make a comment about probability of down? 0.41. How did you get 0.41? 0.49. All right. So then, gentlemen, then it's like you guys want us to use 0.51 here. Let me use here 0.51. Right. So probability of down, probability pi down, pi d, it will be 1 minus pi u. So it will be 1 minus 0.51, which gives me 0.49. I have to double underline. I must double underline this. Even if you use 6%, so long as you say 6% here, remember this is not portfolio. Don't use 6 here without, this is not portfolio is where, because everything there is in terms of percentage, we leave percentages out. Here you have to put this in form of decimal like that, or write 6%, and you'll end up getting the same answer. So thank you, Cecilia. So up to here, ladies and gentlemen, are we together? You're getting already free marks, you can imagine. You're getting already free marks, you can imagine. Now, it is after doing this, ladies and gentlemen, that I will go ahead and draw the tree. So let's go ahead and draw the tree. So you write there, even if you're not understanding anything, you write in capital letters and you underline. You write in capital letters and you underline binomial tree. Binomial tree. And this one is going to be a one-step tree because it's expiring after 1 year. If it was expiring after 2 years, there would have been two steps. Very good question there. Is this pi, which was 22/7 in high school? No. Here we don't look at those things, or 3.14. We don't look at it. Pi for us is P for probability. Thanks for asking that question. Just a simple yes. So then you go ahead and draw the tree. So then, gentlemen, we have here the tree. We have our SO. Our SO is our current spot rate. Please write here current. O means today. Our SO is our current spot rate, which is what year? Which is 80. And then there are two possibilities. The two possibilities are in this case here, this price may grow up. So we have in this case here two possibilities, up, stroke down. So if it goes up, it will be 80 times 1.4. If it goes down, it will be 80 times 0.71. Where am I getting those answers from? Where am I getting those values from? Where am I getting those values from? Take pi to be 3.204. Do you remember that up the u was 1.4 given by the examiner? So meaning it can increase. And the down, of course, in this case here, down has been given by the examiner, or rather has been calculated by ourselves as 0.71. So then, ladies and gentlemen, are you able to give me this, what I'll call S1? The spot price at the end of year one. The spot price at the end of year one, both of them are at the end of year one. Spot price at the end of year one, abracadabra. Spot price at the end of year one, somebody is giving me 112 here. 112 here. And then, ladies and gentlemen, here, what do we have here? What do we have here? What do we have here? If it goes down, we have 56.8. We have 56.8. 56.8. Now, ladies and gentlemen, I would want you to take a different color of a pen. If you've been writing here using a black like myself here, please get a different color of a pen. And help Mwalimu to calculate what we call payoffs. Help Mwalimu to calculate payoffs. Cherry is asking Management-CPA 0.71. Perhaps Cherry lost us a little bit. Remember, the app was given to us. The app was given to us as 1.4. And then to get down, we said it will be the reciprocal. 1 over 1.4. That's how we got the 0.71. I hope, Cherry, you were able to be of help there. Thank you, Shadi. Thank you, Shadi. Now, so I would want us, ladies and gentlemen, to get payoffs because we value these options using payoffs. We value options using payoffs. Using payoffs. And how do we get payoff of a call option? Payoff of a call option. This is how we get a payoff of a call option. We normally pick maximum between S minus K and a 0, right, like that. Let's use X. Let's use X instead of K. Let's use X instead of K. So anytime you hear of a payoff of a call option, ladies and gentlemen, this is how we shall be getting payoffs of call options. We shall be picking between the two figures here. Which one is the higher figure? That is the one that we die with. Max over S minus X, comma 0, where X is the strike price. S, of course, is the prevailing. S is the prevailing. For avoidance of doubt, let's mention here ST. ST, T for time, like S1, like S1. So shall we take ST minus the exercise price, and then we compare this with 0, and then we shall pick the higher. In this question that we are doing, is there somebody who can remind us? Is there somebody who can remind us? Is there somebody who can remind us? Is there somebody who can remind us what the strike price is? Remember, X is the strike price. X is the strike price. Is there somebody who can remind us what the strike price is? Is there somebody who can remind us what the strike price is? It's 80. It's 80. So then I would wish you guys to do me a favor. Now, using a different color of a pen, I would want you to come and calculate for me the payoff here, the PO here. How do we get the PO here? Remember, the rule is very, very clear. You take, in this case here, the stock price, which in this case is 112, minus the strike price, which is 80. Minus the strike price, which is 80. Whatever answer you get, you compare it with 0. Whatever answer you get, you compare it with 0. And then you pick the max between the two. You pick the maximum between the two. You pick the maximum between the two. So the payoff here will be 112 minus 80. Somebody is 112 minus 80, 32. Is 112 minus 80, 32. Is 112 minus 80, 32. Yes. So in this case, you are comparing between 32 and the 0. So which one is the higher? Which one is the maximum between the two? Which one is the maximum between the two? So in a different color of a pen, we are saying here that the payoff here will be 32. The higher between 32 and the 0. The higher between 32 and the 0. So in this case here, we are getting there 32. We are getting there 32. The higher. So then I would want somebody in this case here to come and use the same concept and give me the payoff. PO stands for payoff in this particular situation. In this particular situation, try giving me the payoff there. Let's see abracadabra. Try giving me the payoff there. Try giving me the payoff there. Wilfrida, thank you very much, even though you are wrong, but at least you've tried. You've tried. You've tried. You've tried. You've tried. You've tried. I can see in this case here, most guys giving me a value of 0. A value of 0. The higher. The higher. It is the higher. So let's try, ladies and gentlemen, let's try this. Let's try this. Let's try this. Let's try this out. 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 This is what we have here. So I'll come and write PO here. I'll write PO here. PO. So remember the formula is the same. You take ST. S at the end of time 1. ST here is 56.8. Minus strike price will remain as 80. Strike price will remain as 80. So you come and compare whatever you get here with 0. With 0. And then you pick the marks. You pick the marks between the two. Therefore, the payoff here will be 0. Because remember, ladies and gentlemen, call options, you can never make a loss. That's why they're optional. When you see that things are not working out, you bolt out. You get nothing, but you're better off getting nothing than making losses. You're better off making nothing than making what your losses. So in this particular case, Wilfrida, are you able to see now that 0 is the correct payoff? Are you able to see that 0 is the correct payoff? 0 is the correct payoff. Now, ladies and gentlemen, remember we had the probabilities. Do you remember our probabilities here? Do you remember our probabilities? Do you remember our probabilities of up? Who is able to remember our probabilities of up? I. Probabilities of up. Probabilities of up. So probabilities of up, what are you able to remember? Pi up. Pi up. Pi up. Pi up in this case here was 0.51. 0.51. Pi down. Pi down was what here? Somebody pi down was what here? Somebody 0.49. 0.49. Now, ladies and gentlemen, I would want you to come and transfer these probabilities here. We normally call them joint because we're going to do two trees. We normally call them joint probabilities. So these joint probabilities, ladies and gentlemen, now that we only have one, let's just mention their probability. Let's just mention their probability. So the one of up is 0.51. The one of down is 0.49. So then could you kindly come and give me here what we call expected payoff? Expected. Expected means that you take the payoff that you have here, you multiply with its probability. You take, don't work with the spot prices. We normally use payoffs to value options. So you take, in this case here, the 32 times 0.51. So these payoffs are your cash flows. They're your cash flows. What are you going to expect to get as profits? So you take here 32 times 0.51. There's a ninja giving me 16.32. 16.32. All right. How about this one, ladies and gentlemen? This is 0 times the probability, which is 0.49 here, which of course will give me what figure somebody here, which will give me 0. So then can you kindly give me the total expected? Total expected payoff. Of course, these will be 16.32. 16.32. 16.32. And this expected payoff is coming to us at the end of year 1. It's coming to us at the end of year 1. So I need to discount it. So, ladies and gentlemen, in this case here, this 16.32 is at the end of year 1. At the end of year 1. It is at the end of year 1. So discount it. And therefore, you mentioned there, therefore, the value of the option. Therefore, the value of the option. Therefore, the value of the option will be equal to this 16.32 at the end of year 1 times PVIF at the risk-free. Risk-free, you guys gave me 6%. End of year 1. End of year 1. End of year 1. So then it will be 16.32, 16.32. If remember the formula is 1 plus R. R is 0.06. Raised to end of year 1, it must be raised to -1. So then are you able to give me this value of this option? Are you able to give me this value of the option? So the final answer, after multiplying with 16.32, after multiplying with 16.3, as soon as we are reading from the table, which is still very good, but go ahead and multiply this with 16.32, what are we getting here? What are we getting here? So Janet Rutuku, she's giving me 15.09, 15.4, 15.4. It seems this 15.4, Janet, angalia vizuri. It seems this 15, but again, 15.09 is still as good, 15.1, still within range. So the correct answer is 15.4. Ladies and gentlemen, before I repeat, because I want to repeat this, do you think this is something we can understand, or should we just write it off? You know, there are things we shall write off. It reaches a time when exams are very near, and then we say this one, just like how we are doing it with advanced financial reporting, that for this one, just Mwalimu will show us how to get low-hanging fruits. But what do you think of this? Is it something we can understand? I repeat, is it something we can understand? We can understand it. We can understand it. It's very easy, and it will be there in your exams, and it can really, really save you. This one can really, really save you. This one, it can really, really be a big savior, because there will be very few students, of course, will be able to do this kind of a question if it were to come. If it were to come. So this one, if it was very tough, you know me. You know me. If it was very tough, I would be among us the first people tell you this stuff, ignore it. For your syllabus, good, but for exams, ignore it. If you see me telling you it's a simple thing, trust you me, every student will be able to understand it. Every student will be able to understand it. All of us shall understand it. Step now. You can see that there are 2 steps of students here. They are telling me, Mwalimu, now go 2 steps. Others like governor. Governor is telling me that those formulas in AFM, they are too much. They are not too many. They are too few. You will pass. So long as you're practicing, you will pass. What is your problem? What is your problem? Okay. Please don't write off a topic like restructuring. I see you doing saying, I've written restructuring off. I mean, I've done restructuring very well. Have you not seen restructuring that I've done? There are very many low-hanging fruits. How do you write a whole topic like restructuring, which you know will be? There are topics, if you write off and the examiner brings, then automatically will be an opening stock at RCM next semester. And me, I would want you to, this should be closing. Opening should be in BDA. Opening should be in BDA. I want you to be the first student in BDA, not in AFR, not in AFR or AFM. The topics you can't, the topics you can't tell me that I'm sad with Frida if you tell me that you have already written restructuring off. Okay, now I can see students who are complaining that Mwalimu, there are many, many formulas. It's like every day we have a new formula in AFM. So tell me, what do you want me to do? To concentrate with the formulas that we are so good at, or to introduce you guys to things that can help you in an exam? Even if there were 1 million formulas, are you the only one who is seeing them to be a million, or is it for everybody? It's for everybody in Kenya, isn't it? It's for everybody in Kenya. So I'll not have an issue, because it's like a rite of passage. It's like a rite of passage. It's for everybody. It's like circumcision for men. It's a rite of passage. Whether you like it or not, you have to pass through AFM for you to become a certified public accountant. All right? I should pray for them, right? One or two more. That's what we should discuss now. You're not the only one. And you will pass, trust you me. You will pass. You can't go through our hands, ladies and gentlemen, we are among, actually not among the very best, but we are the best in the industry. We're the best in the industry. Once you have gone through our hands, and of course, you know, like now these things are doing last minute, you keep on reviewing them, you will survive. You will survive. So then, ladies and gentlemen, look at example 2 before I can't repeat using the first example. Example 2. The current price of a stock is 𝐾𝐻80. Is 𝐾𝐻80. The size of up move is 1.4. The size of up move is 1.4, and risk-free rate, and the risk-free rate, and risk-free rate, and risk-free rate is 6%. Pretty similar with the one that we did, 6%. The strike price of a put option is 80. The strike price of a put option is 80. Is 80, and expiry is 1 year. And expiry is 1 year. And expiry is 1 year. Full stop. Using a binomial tree, using a binomial tree, determine the current value of the option. 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 This is my very best cohort. You guys are the best cohort that I've ever taught. Actually, after exams are over and after results are out, you pass, I should be able to organize a good lunch or dinner for you guys in Nairobi. You guys are the best. You made me laugh. You made me even look younger. Retweeting the Basha, I've one CPK, usema, 𝐁𝐸𝐵. All right. So, ladies and gentlemen, if I get this example like it has come not once severally, if you look at our past papers, remember this is just one step, not 2 steps. If I get this kind of a question, the first thing that I will do is to come here right away, and figure out things here. So I have here, this first step is up, down move, moves here. So they have given me the up move. They have told me the up move is 1.4. Then is there someone who can give me the down move? How do we get the down move? Is there someone who knows the relationship between the two? The relationship between the two. Is there someone who knows the relationship between the two? 1 over u, yes. So this is 1 over u. So it will be 1 over 1.4. I want us to assume that you have never seen this before. 1 minus 1.4, or rather over 1.4, which gives me 0.71. That is step number 1. Then who is able to talk to me closely to my ears and tell me in this case here what the next step will be? Probabilities. Thank you so much. Probabilities. And here is where the rubber meets the road. You know, when you are descending down with an aeroplane, of course, in this case, when the rubber meets the road, it normally becomes quite tumbling, all right? You can easily tumble down. When this thing meets the road, it's quite rough. So if you're able to know the formula of getting probability, pi u, you are a very good person. Pi u will be equal to pi u. Let me see whether there's any student who will be able to write down the pi u. Of course, we know the answer, but we want to just do it. Pi u. Abracadabra, they have written it in their notes there. It is what here? It is 1 plus risk-free minus down. Don't subtract u here. Minus down all over u minus down. So do we have, ladies and gentlemen, our risk-free rate? Our risk-free rate in this case here is 6%. Our risk-free rate is 6%. So this will be 1 plus 0.06 minus down. I can see down is 0.71. Down is 0.71 all over, in this case here, u minus down. U up is 1.4, up is 1.4, minus down, which is what here, somebody, 0.71. So please go slowly here to the level where you are able to give me the upward pi, the upward pi, the upward pi, the upward pi, upward pi. It is 0.51. The students who are telling me to repeat. Up to here now, are they able to see things really? Are they able to see things really? So pi is 0.51. Thank you so much. So having gotten the pi u, then the next one will be the pi d. Pi u gives birth to pi d. Gives birth to pi d. Pi d. Pi d. Pi d. So please go ahead and give me the pi d. Go ahead and give me the pi d. Go ahead and give me the pi d. Let me see in this case here whether there is anybody who will be able to give us the pi d. Pi d. What is our pi d? What is our pi d? So our pi d, ladies and gentlemen, we know that pi d is 1 minus pi u. So it is 1 minus 0.51, which gives me 0.49. Ladies and gentlemen, after you finish probabilities, now you go to the last section. The last section is a tree section. In this case here, you go up a tree. We are only going to have one step tree. So in this case here, we call it the binomial tree. The binomial tree. So this binomial tree, we are going up like this and down. So we know the current SO, the current price is 80. But it could go up by 1.4 multiplier or down by 1 point what here, somebody not 1 but 0.71. These are multipliers. So then I should be able to use this to get S1 and S1. There are two possible S1s. 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 So if that happens, then, ladies and gentlemen, what are we going to get? What are we going to get? If that happens, how I wish I had students who are very courageous. And I can see we have got more ladies who are more courageous than men, which is really sad. It's like some men here are giving up already. So these ninjas of mine, what do I do to them? What do I do to these men, ninjas of mine, who want to tell me that Mwalimu is very hard? What do I do with these ninjas of mine? So in this case, we have our SO. Let me just repeat this. We have our U of 1.4. We have our D of 0.71. So we have our S1, which will be, in this case here, SO is 80. So it will be 80 times 1.4. It will be S1 here, 80 times 0.71. And I can see Shady giving me 112. Shady is giving me 112. And then this one here is 56 point something. 56.8. Now from there, ladies and gentlemen, I would want you to listen and listen to me very well. Whenever it comes to the put options, to get payoff of put option, to get payoff of put options, this is normally what we do. We take maximum of K minus S. Let me use X. We reverse the other formula. Minus ST versus 0. Remember, for put, you are selling and the strike price becomes a revenue to you. The strike price becomes revenue to you. For you to get now a profit, then of course you take revenue minus the cost of the stock. So remember, for the call, the strike was buying price. It was buying price. That's why we were subtracting. But now for put, X will be my receivable. X will be my revenue. So whenever it is put option, I shall always reverse this thing. So it shall be X minus ST. Please don't forget that this X is the strike price, and the examiner will give it to you. So in this case here, this X is a strike price, which in this case here, the examiner has given us as 80. So then I would want you using a different color of a pen. I would want you guys to come and write for me the PO box. PO, give me a value here, and the PO here, down here, give me a value. Let's see, abracadabra. Abracadabra. Do we have very serious ninjas? Do we have it must always add up to 1, yes. Probabilities must always add up to 1, always. They'll never miss. I know the mistake that students are doing, you'll get some of them in this case are confusing these two for probabilities. Even this is more than 1 already. This is upward. You see, the upward is like the price will increase by 40%. So the upward will be 1.4. Probabilities are here. We have already got the probabilities and they are adding up to 1. Don't confuse you and deal with probabilities. And of course, it is many students who confuse that. I hope 𝗕𝗵𝗆 have been able to answer you. So abracadabra, I can see 10 new messages. 10 new messages. Are they telling me something nice? So according to Madam Winnie Mandela, 32.0. Ananiambia mwalimu ya kwanza wewe andika 32.0, wacha mambo mengi. Ya kwanza ananiambia mwalimu andika 32.0, wacha mambo mengi. Ya kwanza ananiambia mwalimu andika 32.0. Hiyo ni Winnie Mandela. 32.0. Mzee amesema no. Ni 0. It is 0. It is 0. It is 0. Actually, kitu tainanga mambo ya kucompare. Wewe so long as ukumbuke kwamba put option is X minus ST. Ukumbuka tu X minus ST, wewe ushapita mtihani. Because kama hapo utakuja useme PO is X is 80. X is 80 minus T, which is 112. And then I get myself writing a negative answer. Then I remember very fast, hey, in options, you can never get an option. When you see an option, write equals 0. When you see an option there, and you're getting PO, which is going to give you a negative, it's not possible to get a negative payoff. When I see a possibility of getting a negative, I will always write what there? I'll always write 0. And then for down, ladies and gentlemen, I can see in this case here, I'm using this formula. It is X minus ST. Leave alone even this 0 thing. It is X minus ST. So X here, X of course is 80 minus, ladies and gentlemen, my ST, which is 56.8, which will end up giving me how much? It's positive. Now I'm happy. I'm going to make a profit here. Which is 23.2. Now from there, please for the two events, please give me the probabilities now. For the 2 events, give me the probability. Give me the probability of the first event. This is the probability upward. The pi up. In this case here, you guys have already a figure. Do you remember the pi up? It was 0.51. And then here, of course, we have pi down. Pi down was 0.49, like that. And then come and give me expected payoffs. Expected means you do tata. You take a payoff. Don't take this value here. You work with POs. We always average the POs. So take this figure times the probability of upward. So this gives me 0. You take the PO here, which is 23.2 times 0.49. What are we getting, ladies and gentlemen, here? We are getting 11.368. Like that. And then now expected values, you can add them. Please add them. You will get 11.368 like that. And this is a total expected, which will come at the end of year 1. So if it's at end of year 1, go ahead and discount it. If it is at end of year 1, go ahead and discount it. To get now value of this put option, go ahead and discount that. Go ahead and discount. Yeah, if you know the formula, it's very easy. So go ahead and discount. So when discounting here, to get value of the put option, I will take that 11.368 times PVIF, because it's end of year 1. Now I'm discounting it at 6%, 1 like that. So then this will be 11.368 times, we know the formula of PVIF. Hey, you great people. It is 1 plus R raised to negative n. So it is 1 plus 0.06 raised to negative 1. So then in that case, what will be the value of my put option? Somebody is giving you a figure of 10.73, 10.72. That's pretty cool. That is pretty cool. That is pretty cool. That's pretty cool. That is pretty cool. So is there someone who has been able to pick something now out of this? However small, however small, however small, it doesn't have to be like everything. No, ST is not strike price. Strike price is X. X. Strike price is X. X. S in this case here is the stock or the spot price. X is always the strike price. No, where do we make use of our SO? Remember, this SO is the one that you're pulling up. Without it, you can't make moves. SO is the one that you're using the multipliers to get the new figures. After that, it becomes irrelevant. After that, it becomes irrelevant. After that, it becomes irrelevant. Okay, so a student is asking, why are we getting different answers and yet it's supposed to be the same? Are they the same? Are you not seeing like when we are getting the payoffs, the other one was up there? Are you not seeing those different? Those values are not the same. Because in this case here, one is a mirror image of the other. Here now we are doing what here? We are valuing a put option. They can't be the same. Because the payoff figures you are multiplying there, they cannot be the same. They're not the same, so the final answer cannot be the same. So long as in this case here, you get the concept really. So long as you get the concept really. Yeah, call put, yes. All right. What do we call U and D? Just like that, up. U is an up. You can call it an up factor. D is a down factor. Up factor and down factor like that. So now, are they ready for a great example? Before we go to a person, are they ready for a great example? Are they ready for a great example? Which now should be 2 steps. Now we are going for our 2 steps. Now we are going for a 2 steps model. A 2 steps model. Now we are going for a 2 steps model. 2 steps model. Before we do the one that came there in the past papers. So now we have 2 steps model here. So exercise 2-year call option. 2-year call option. So they have given me SO. They have given me SO. SO is 50. They have told me X is 45. 45. They have given me U, which is 1.25. And they're so nice. They've even given me D, which is 0.8. Then they have given me risk-free, which is what year? Which is 7%. 7%. So required binomial tree. Required binomial tree. And remember, this is 2 steps. That's number 1. And then you determine value of the call option. You determine the value of the call option. You determine value of the call option. You determine value of the call option. If it's here 2-year, even if you're not told, when you see here it's a 2-year, then that has to be a 2 steps model. It must be a 2 steps model. It must be a 2 steps model. All right. So CPO Pondo, chairman of the panel. Chairman of the panel. All right. All right. I told you this is my best cohort of students. You can see we are still 169. The ones who run away are 30. I expected like all of you to run away, but I mean, You guys are still holding on, meaning that there is something they're trying to understand. You guys are great. To be pros, yes. Now, ladies and gentlemen, this is not a hard thing. I will get all the marks. I'll get all the marks. Can somebody in this case here give me the PO formula? Let me start with this. Is there somebody who is able to give me the PO formula for a call option? Anybody who is able to give me the PO formula? PO formula. PO formula. PO formula for a call option. So it is ST minus what here? The strike. If negative, you take 0. 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 So at least that is something that is very nice. That is something that is very nice. Now, ladies and gentlemen, after that, then I would want to get, in this case here, my up and what here? My up and down. My up and down factors. Up and down factors. So up and down factors, that is U. U already has been given. This is 1.25. Down has been given. I'll not even try to see whether it's 1 minus D or whether it's working. But in an exam, if you're given the values of U and you're given down, don't try to tell the exam that you are wrong, that you know the association. No. You take this the way they are. So after up and down factors, the next thing will be for you to come here and give us now the pies, the probabilities. The probabilities. These are 3 marks, I can assure you. So I would want someone to give me the pi U. The pi U. I'm giving you exactly 1 minute. You give me the pi U. The pi U. Remember, X is the strike price. X is the strike price. X is a strike price. ST, yes, is a spot. ST is a spot. ST is a spot. So I want to see whether there is any ninja that will be able to give me the pi U, given the formulas that I have been able to give to you. Given the formulas that I've been able to give to you. Given the formulas I've been able to give to you, let me see whether there's anybody who will be able to give me pi U. Pi U. Pi U. Pi U. Pi U. So they're giving me a figure of 0.6. These guys are geniuses. They're giving me 0.6. These guys must be geniuses. 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 They're telling me, Mwalimu, you know what? We know, first of all, the formula of pi U. We know that pi U should be equal to 1 plus risk-free minus down, all over U minus down. So then in this case here, my pi U will be equal to 1 plus risk-free. Are you able to remember that the risk-free is 0.07? Minus down, which is 0.8, all over U, which is 1.25, minus down, which is 0.8. So you get your calculator. So you get your calculator. So your calculator, this is what you have here for a calculator. So you have here 1 plus 0.07 minus 0.8 equals. So then, gentlemen, here, I'm able to get 0.27 all over 1.25 minus 0.8, which gives me 0.45. So then go ahead and divide. So 0.27 divided by ounce of, so this gives me 0.6. Is there anybody who got 0.6? That's pi U. Pi U, yes, they're getting pi U. And I can see Janet has even been able to get the pi D. I can see Janet has been able to get the pi D. She's really known that pi D will be 1 minus, the 2 are complementary. So then this gives me 0. What here? This gives me 0.4 like that. This gives me 0.4 like that. I'm telling you, once you reach there, you are not like down. I'm telling you, very few students in Kenya. Like, let me ask you a question. There must be students in this case here who did that sitting that I've just read for you. That sitting that I've just read for you. Please, if you have to be very honest, were you able to write even anything like Anochugunu, however small, were you able to write anything in that question? The December 2022 question that I've just read. Were you able to write anything? Anybody who tried that? Nothing. So So you can imagine like now, any student who is able to come and write up to here, as an examiner, you will give this guy like almost 100%, especially if he's able to draw the tree. This is the good thing with difficult questions. Difficult questions, you can end up getting like all the marks without knowing what you are doing. Without knowing what you are doing. Unakuwa ndio mkuu. Sasa hilo unakuwa meeting it today. We shall overcome, okay? We shall overcome. We shall overcome. We shall overcome. All right. So, ladies and gentlemen, please listen and listen to me very well. Now we have the pi u, we have the pi d. Then what do you think in this case here should be the next thing to be done? We can't go to payoffs without the tree. First of all, we must draw the tree. Let's draw the tree. We draw the tree. We draw the tree. We draw the tree. So I want to give you exactly 1 minute to see how you guys are going to draw this tree. Let me give you 1 minute as I take a little break. I want to see whether there's anybody who will be able to draw a tree of 2 steps. A tree of 2 steps. A tree of 2 steps. Utaniwekea pilipili kidogo ichemke ndani. Na ikuwe ready by 4 p.m. Sukuma ni better. Weka ndani. Weka ndani hivyo pamoja. Utaweza reduce mafuta. All right, so ladies and gentlemen, let me draw this tree for you. I'm drawing now this tree for you. So this is what we are doing here. So remember, it is 2 steps. So do we have SO? Do we have SO, the current stock price, 50. Do we have the U? Upward is what here? Upward was 1 point. Upward was 1.25, isn't it? 1.25. So downward is 0.8. So meaning in this case, I'll come and take 1.25 times 50. And then I'll come and take 0.8 in this case here times 50. So are you able to give me these figures? Or are you able to give me these figures? Or 62.5. 62.5. How about this 0.8 times 50? 0.8 times 50. 0.8 times 50. That gives me 40. That gives me 40. This is step 1. Whatever I've done is step 1. Then we go to step 2. We go to step 2. Now we go to step 2. So step 2, this is what will happen like this. Remember, up and down will remain the same. So this will be 1.25, down is 0.8. The same. We have up, we have down. So we have here 1.25, here we have 0.8 as down. Down 0.8, like that. All right. So then can you kindly give me the value to write here? You see up, it will be 62.5 times 1.25. 62.5 times 1.25. So please multiply these two, multiply them like that. So the first one, I'm being told here 78.125. So this is 78.125. And then this is 62.5 times 0.8. 62.5 times 0.8, which gives me 50 exactly. Somebody telling me it's 50 exactly. So then you come here, ladies and gentlemen. Come here, ladies and gentlemen. Please do the multiplications here. So 40 times 1.25 gives me what figure? 40 times 1.25 gives me what figure? So in this case here, because they will have to be the same, yeah, they have to be the same. And then we have here 40 times 0.8. 40 times 0.8 gives me what figure? Somebody here gives me 32. 32. Thank you very much. 32. 32 like that. Now from there, very fast, what you will do, you will come and create a column here for payoff. So for payoff, remember payoff here, you are taking, because it's a call, you know, it's a call option, the strike price becomes a cost, and you always subtract cost. So like now we have the spot price is this, minus, so we have here, the payoff here will be 78.125 minus. Is there somebody who is able to tell us what the strike price is? Is there somebody who is able to tell us the strike price? Is there somebody who is able to tell us the strike? Remember, this is a call option, Charity. For a call option, call you are calling. So when you're calling, the strike price given there is a cost to you. You're going to buy, because call option gives you the right to buy. So it's 45. So 45. Remember the formula. Remember the formula for payoff for a call. It is the spot that you have there minus the strike. Minus the strike. All right. So like now here, the spot which I have here is 50 minus the strike of 45. So here it will be 50 minus 45. Here it will be 32 minus 45. The strike is always known in advance and will remain constant. Always known in advance and will remain constant. So is there somebody who is able to give me these answers pretty fast? Pretty fast for payoffs. For payoffs. So according to Winnie, the first one is supposed to be 33. 33.125. 33.125. 33.125. How about this 50 minus 45? This is very easy. This is 5. This is 5. This is 0. The last one is 0. The last one is 0. You can see now Ken. You can see Esther. Wamelamba chini pungulu. Wamesahau concept. But at least they're awake. They're awake. They're awake. In options, you will never make a loss. Whenever you see a possibility of making a loss, you write Z. Don't even mention the word compared to 0. Whenever you see a possibility of making a loss, what do? You simply write what here? A 0. You simply write a 0. How do we get this 45? It's given in the question. If you look at the question, they've given us X as 45. It's given in the question, the strike price. The strike price is given in the question. Maybe somebody can take a screenshot and then they send in the group. It's given in the question. Any other question? Any other question? Are we able to see why we are writing 0 here? Because it's loss making. And in options, we shall always be, you know, there are 3 types of options, as we shall be seeing. We have what we call in the money. In the money options are profitable options. Out of money are loss-making options. We shall never go there. And then we have what we call at the money. At the money means break even. So normally the viable options will be the at the money, which is 0, or in the money. In the money means profitable. In the money means profitable. So when you get out of money, you simply put a 0 there. Like now, this is out of money because it's loss-making. Loss-making, we call them out of what here? Out of money. Why aren't we doing the 50 minus 45? Why? The concept of payoff. All right. Remember, how do we get payoff? I've spoken about this severally. Perhaps you guys are not keen on this because some of you are writing it off, because I've spoken about this severally. We've said payoff is a spot price, and these that you have here are your spot prices. the ones that you have here in spot prices, minus the strike price. And strike price has been given as what there in the question? 45. The strike price has been given there in the question as 45. So simply take the spot prices given here minus the strike. And if you happen to get a negative answer, negative payoff, forget the negative and then you write what somewhere there? 0. So like now this is positive, good. This is positive, 50 minus 45, 5, good. 50 here, minus 45, good, 5. And then we have here 32, minus 45, giving me a loss, bad. So I will say that is out of money, and then I recognize 0. I recognize 0. It's very easy, by the way. It's very, very easy. Why aren't we doing? Why are we doing 50, 45? But we have got two 50s here. There's this times this, which gave us 50. And then we have got 40 times this. So we have got two 50s. So we have the two of them. 50 minus 45, 40 minus 5 like that. All right. Follow the tree, yes. Now, after that, ladies and gentlemen, you'll now come and give me the joint probabilities. So the last step, give me the joint probabilities. So are you able to remind us what the probabilities were? Are you able to remind us? We had pi u. Pi u was equal to what? Pi u was equal to what? Pi u was equal to what? 0.6. And then we had pi d. Pi d was 0.4. I'll write it here. Pi d was 0.4. So remember up, it's pi u. So pi u here is 0.6. This pi d, which is 0.10, is 0.6. Pi d 0.4. This is pi u, which is 0.6, and this is pi d, which is 0.4. So, ladies and gentlemen, I want us to follow our tree to be able to get what we call joint probability. We join the probabilities. So, like now here we have this figure. If you follow the tree, we have got two probabilities here we need to join. If you follow this tree, two probabilities, we have 0.6 and we have 0.6. Join them as an and probability. Multiply them. So is there somebody who is able to see the joint probability for the first figure? The joined one. So the joined one, here we have 0. What here? 0.36 like that. How about this other branch? The second branch. Follow it as if you are driving a Subaru vehicle. So in this case, you follow it like this to the origin. I don't know whether origin is 𝗕𝗵𝐴. So you follow it. You only take the probabilities along the way. So here we have got two probabilities. So we have 0.4 and we have 0.6. 0.4 and the 0.4. No, follow this as if you are driving a Subaru one. It's a road. There are two probabilities. It is 0.6 and 0.4. Giving me what figure? Somebody there? 0.24. Giving me 0.24. How about the third road? Let's see. Somebody who is good, a good driver. The third road. Is there somebody who is able to see the third road? With a Subaru. So the third road is this one. So I'm going like that 0.6 and a 0.4. I'm going like that 0.6. I can see 0.6 here and a 0.4 here. So still giving me 0.24. 0.24. And then lastly, the last road, ladies and gentlemen, is this one here. 0.4 and a 0.4. So 0.4 and a 0.4 gives me what here? Somebody? 0.16. It gives me 0.16. It gives me 0.16. Then do me a favor. Come and create. I don't know whether they'll be able to see this board of mine. Come and create it now. Last column of expected payoffs. Expected payoffs. Please round off to 2 decimal places. Expected payoffs. So like now we have the first payoff here, 33.125 times 0.36. I only want 2 decimal places. Give me this times this. Give me an answer right there. So according to Janet, we have 11.93. 11.93. And then we have now this times 0.24. What are we getting there? 5 times 0.24. What are we getting here? It is 1.2. So this is 1.2 and this is 1.2 like that. And then of course the last one is 0. So come and give me the total expected payoff. Give me the total expected payoff. The total expected payoff. Total expected payoff will be equal to who? Total expected payoff will be equal to 14.33. This will be 14.33. This will be 14.33. And this payoff here will be coming to us at the end of which year? At the end of which year? This will be coming to us at the end of which year? At the end of year 2. And yet I want the present value. 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 So then I want the present value. So then how do I get this present value? So to get this present value, ladies and gentlemen, to get the present value, this is really a very easy thing. To get the present value, this is what we shall do. To get the present value, so to get the present value, which in this case here will be the same as value of call option, what I'll do, I'll come and take that 14.33 times PV at the risk-free rate. Risk-free rate was 7%. Number of years, second year. Then remember that our PV is 1 plus R raised to negative n. So R is 7%. So then this one here will be 14.33 times 1 plus 0.07 raised to negative 2. Raised to negative 2. Raised to negative 2. So is there somebody who is able to give me this value? Negative 2 because of the 2 year. Second year. So is there somebody who is able to give us this value? Imani gives me 12.69. Esther, just give me the answer directly. Because you have that value now times 14.33. Give me the answer directly. What do we have there? Give me the answer directly. I adjust the board. My board is not behaving well. All right. So you're getting, ladies and gentlemen, 12 point something. We are getting, ladies and gentlemen, here 12.52. We are getting 12.52. Let me ask you a question, my good students. You have to be very honest with me. With this kind of small exposure I've given you, is this thing really that hard? Is it very, very hard that we write it off? Is it very, very hard that we need to write it off? Is it very hard that we need to write it off, that we should write it off? Is it hard that we need to write it off? Not really. You'll be surprised. Even this one, when you compare this question to some questions in cost of capital, the financing decision, when you compare this, for example, to like some questions under Modigliani and Miller, you would realize this, because this one, if you have the format, you are assured of getting all the marks. You are assured of getting all the marks. Kumbusha how to use calculator or PV, where Sylvia, 1 plus 0.07 raised to negative 2. Sylvia, Kumbusha, it's very easy. So then you'll come and get here 1.07. You will use the raised to minus 2. Raised to minus 2. There is a raised to their function. Stop those other shortcuts. So 1.07 raised to minus 2. Raised to minus 2. The practice, yes, raised to minus 2, then you should be able to get that answer. The normal raised. Now, from ladies and gentlemen, you will allow me to give you some guidance as regards now to this question. There is just a small variation. April 2023. Question number 2B. April 2023, question number 2B. April 2023, question number 2, boy. April 2023, question number 2, boy. Have we gotten the question, ladies and gentlemen? Do we have it? Do we have the question? Yes. So consider a 2-period binomial model in which a share currently trades at a price of 65. So my SO is 65. The share price can go up 20% or down 17% each period. So is there somebody who is able to give me the up value, given the information they have given us there? You will be equal to what? Somebody abracadabra. You will be equal to what? It can't be 0.2. If you take 0.2 of this, will it go up? Will it go up or down? Just try. What is 0.2 of 65? What is 0.2 of 65? What is 0.2 of 65? So in this case here, they have given us, and so it should be 1 plus the increase, because up has to be 1 point something. So it will be 1 plus the increase, which is 20%. Wamekwambia, the share price can go up by. So to be able to know up to what, so it will be 1 plus 0, so which is 1.2. And then down, they have told us it can go down by 17%. Or down 17%. So then in this case, ladies and gentlemen, our down will be 0.83. It will be 1 minus 0.17, giving us 0.83. So that is the only variation. That is the only variation in this question. Otherwise, every other thing will remain the same, given the fact that, remember, this question is a what year? This is a put option. This is a put option. I have a suggestion that you guys, in this case here, you have 65 plus 13. Where is 13? Where is 13? I'm not able to see 13. Where are you getting 13 from? It is the 20%. Okay, so you see, like for example, let me explain. That's a good question here. Let me explain here. So you see, we have 65, and they're telling us that up, this figure here will increase by what year? May increase by 20%. So increasing by 20%, and that would mean that you take 65 plus maybe 65 times 20%. Right? Because now increasing, going over and above, it can't go down. And you can't tell me what 𝐻𝐻𝐻 is. Can you take a number and then you add 20% to it? Can you take a number and then you add directly? No. It has to be percentage of that number. So the very best, whenever they give you the percentage increase, you are better off working it out this way. Or you do it this way. You can as well do it that way. You'll end up getting, in this case, the same answer. The same answer. All right. So it's a put option. So what I'll do, ladies and gentlemen, is to give you guys a few hours. You do that question to the end. And then as usual, of course, you guys are great students. You'll need, in this case, to do what here? To post your answers. You'll need to post your answers on WhatsApp, and then we compare our workings. And then we get to see who is correct and who is wrong. Does that sound like a plan? Does it sound like a plan? I'm so sure there must be a ninja who wants Mwalimu to do everything. There must be a ninja who wants Mwalimu to do everything. There must be a ninja who wants Mwalimu to do everything. Maurice, we used the total expected payoff. Perhaps there is something you missed. I was always adding the total. Always. I was coming here to this, adding the total. This total here is 14. They added. Remember very well. We use the total. The FM is full of. I'm not seeing any surprise there. Perhaps you guys now, you are reaching what we call saturation point. You know, like when you're doing research, as a scholar, you reach a point where you are interviewing people, and then you realize that there are now new themes. You've done, for example, you wanted to do like, say, 30 interviews. By the time you're reaching interview number 21, you realize that interview 21, interview 20, interview 19, all of them are giving you the same themes. We call that a point of saturation. To me, I'm not saying this one to be a big thing, really. It is something which is doable. After all, if it's not doable on your level, then nobody in Kenya, like, you know, the students who are joining us here from other colleges, who have done this thing in other colleges, can you kindly be honest with us? Had you ever seen this kind of a thing with your teachers? Be very honest. Had you ever seen it? No. And that's why I would rather do them, just in case the examiner brings something like this, then we should be at a point of vantage, high pedestal. Bado, msianze kulialia. Msianze kulialia. Msianze kulialia. Bado. We need to do these things. You know, there are areas that I can tell you, if you happen to know, you will never ever fail in AFM. And I have to touch those areas, whether you like it or no. I have to touch those areas. And all of you must be perfect on them. Because nobody's failing, remember. Nobody's failing. Nobody's failing. Nobody's failing. Nobody's failing. Nobody's failing. You keep on complaining, but at the end of the day, you have to understand and you must pass. Do you think Maurice is saying the truth here? In which example do we use 11.368? I'm so sure Maurice never took one aspect here to be 0. All these guys here cannot be wrong. All these guys, you can imagine all of us ninjas here 160. We can't be wrong. I'm so sure Maurice, there is something he never did. So in this case, he took 2 numbers here, giving him a very big, we can't be wrong. Is it possible, Maurice, for you to just take a snapshot of the question you're talking about, and then you send it on WhatsApp? You have a look at it. You have a look at it. I'm so sure you are wrong. You're wrong. I'm so sure you are wrong. We shall overcome. We shall overcome. Otherwise, I've really had a very nice session with you guys. So I'm looking forward in this case here to meeting you for AFM again. So AFM next class is tomorrow at 1 p.m. Now, tomorrow at 1 p.m. is an SPR session. I want to believe that all of you paid for the special education classes. It's important. It's important. Although the same concept again, like this one of black scores, we shall still teach them in the normal classes. But right now, if possible, don't miss any class moving forward. We shall overcome. And then, of course, we are looking forward to you guys starting your leave days. Starting your leave days. Like Mwalimu here has even requested his boss to start his leave days immediately. Fortunately, me, I'm at a place where I'm able to control things. Because I'm a good marketer, I'm able to give them market. So I control things. So I'm able to tell this guy this time around, I'm taking my break, mapema, wanakubali. But even yourself, you take many breaks. I mean, not many, but just a few days off. All right. The other thing, ladies and gentlemen, now you guys, when you go to my YouTube channel, I don't see you commenting there. You don't want this Mwalimu to rank very high in this search engine optimization. You must comment there. Use our language there. All right. There's something there. Give me thumbs up. Share those videos. You need to uplift your Mwalimu. Mwalimu would want to retire a very happy man. And one of the ways of him retiring a very happy man is to have YouTube, which gives him like 300,000 a month. YouTube giving Mwalimu 300,000 a month, I would really, really be a happy man. And that can only happen if you do that. Of course, the ads there, you can skip them. Given the exam proximity, I can tell you that be watching all adverts. No, that would be very unfair on you. But at least the thumbs up, commenting there, that one is mandatory. That one is not an option. That one is not an option. So for our AFR today, have we gotten the chance of watching this video on IFRS 17, all of us to the end? Because you're supposed to start AFR immediately after this. Have we watched that video to the end? Have we gotten time ninjas? Have we gotten time ninjas? Like Motinda, yes. Maurice has seen it, yes, you can see. I knew. Not yet to win. When you promised me to do it immediately. Brian, yes. Just lack of from market halfway, friendly half. No, ni swali. Ninyi mnakosa time ama ni passion mnakosa ya kutosoma? Ama hebu niambie ukweli. Really promise asubuhi mtaona. Na nikawapatia nafasi yote asubuhi. What is not happening? Ama mnachoka sana? Hebu niambie ukweli. Mimi ni baba yenu, mpaka mniambie ukweli. Hebu niambie ukweli. Mnakosa passion ya kusoma ama ni kuchoka? Because people nasema time. At least Leah watched. Learning curve. Pressure time. Work and school inampeleka mbio. Lakini we shall overcome. So sasa tutafanya nini? Hiyo na nimeprepare kufunza hiyo kitu ya insurance. Ama mnaona kama itakuja. I have a solution. You guys mmesoma leo ya kutosha with mwalimu. Everybody make sure kwamba ameangalia hiyo video. I'll not meet you today. But come next, is it next weekend? I don't know. We'll again organize a special class to do that insurance question. So take today's evening time to watch that video. Na sasa kile mwanafunzi akiwatch akimaliza anaandika pale done or not understood wherever. I would really be very happy to see that everybody has watched that video. The students who have been able to watch the video, is it something that you guys are able to understand? Let's motivate the guys who are yet to watch. Is it something that you're able to understand on our own? Or is it a very difficult thing? Instead of me coming here to shout, and then you have an easy video there, I think that is the best thing to do. That is the best thing to do. Remember, we are passing in all papers, not AFM alone. We are passing in all papers. There are some students who have also requested me to take them through leadership and management. Leadership and management. Sasa hii class ikiwa mingi nikianza kuwafunza tena LM, hizo case question, class sasa zikiwa mingi ni kama mnaanza kuchanganyikiwa. Mnanistua. Mnaanza kuchanganyikiwa. Mnaogopa sana. Ili kama mambo ndio mengi. I agree, Morris. I agree. Lakini imagine Morris hata ikiwa mingi hivyo, lazima tu create time Morris. Lazima tupite Morris. Lazima tupite. The best, mwalimu akipana ka video kamoja ka 50 minutes mapema. Wewe kamalizana nako mapema. Mbona mimi ni mwanafunzi bado? Na mimi nafanyanga homework zangu zote. Nafanya diploma ya IFRS, nafanya June. Mimi nafanya homework yangu yote. Hakuna siku kwa class mimi niko very active. Very active. Iko tofauti gani yangu na yako? Iko tofauti yangu yangu na yako? I think it's about motivation. I share the video. Governor is getting all of them 0. We shall see. But at least you have made a step. Replace an AFRS, they understand you. Share the video. I'll share. I will share. All right. So, ladies and gentlemen, then we shall take it like we have finished. I'll also get time to look for those notes about mnasemas AFM theory, which I'll be able to share by the end of the day. And then for leadership, when do we do this leadership then? Like now that I'm very free, now that I don't have AFR, in the evening, please apologize on my behalf. Wanafunzi groups za AFR waambie your class, kila mtu watch your video insurance. I don't insist on things that easily. Ukiona insist, maybe Mungu anatumia baraka ya mzee kukubariki na ujumbe. Because it is in the syllabus. Insurance and banks, it is in your syllabus, AFR syllabus. So for leadership, let's discuss in the group and see how best mwalimu will be able to assist you. Maybe today 1 hour, like maybe after 10 p.m., like 30 minutes, we can see what to do for all students in this case here to survive. Otherwise, thank you very much. Be blessed. Timetable I leave, yes, that I should be able to give you a timetable, yes. Bye. Be blessed to Juliana. Yes, we have CPS. Please call 0719 525 000. We have CPS. It's called CS nowadays. 0719 525 000. Thank you. Bye, Mr. Ken. Bye. Tips for AMA is written in Mingi. We shall overcome. I'll be able to give you tips, yes.